Hello traders, Gary Wagner here. Just before 1 o'clock in Honolulu, 7 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 20th day of August, 2021, and this is the daily report for gold and silver, our weekend review. An interesting week in that we had an extremely muted range in gold. It closed fractionally lower on the day, fractionally higher on the week by only $2. But considering that the dollar itself gained almost a full percentage point in value and gold was able to eke out any kind of a gain, tells me that there is still support in the market, there are buyers in the market, and they're waiting for more clarity on some of the issues I addressed in our opening letter. The same cannot be said for silver. It continues to tumble, breaking below $23 today, closing at $22.97. Gold today lost approximately 50 cents, and basis the most active December contract is currently fixed at $1,782.60. When we compare that to Monday's open or a weekly chart, we can see that gold had a fractional gain of approximately $2 this week. That is a huge accomplishment considering that the dollar index itself hit a yearly record high yesterday. On a weekly chart, it closed at its highest value this year and gained approximately 1% in trading this week, although today it did close lower by just over 0.1% and is currently fixed at 93.47. Silver continues to lose ground, selling off by 26 cents today, over 1.1% decline. Currently, we have September futures below $23 at $22.97. This first chart that we are looking at is a weekly candlestick chart of the U.S. dollar index. Interestingly enough, we hit a record close in terms of the highest price the dollar index has been valued this year. Yesterday, we had a small decline of just over 0.1% today. But that being said, when we look at our weekly chart, we absolutely have the highest closing weekly value this year. The lowest value came at the beginning of 2021 when we were trading just above 89 on the dollar index, and the former intraday high came in at around 93.47, which is precisely where we closed today. But you can see that on the last week of March, when we hit the intraday high, it did close much lower, actually closing closer to 93 than 93.40 or 93.50. That is significant because this week alone, the dollar has gained just shy of a full percent in value. Another significant factor in the U.S. dollar this week was today's intraday high, which is the highest trading value this year when the market traded to 93.75. Of course, it closed at 93.47, which matches almost precisely the highest intraday high that occurred back at the end of March of this year. And even with today's slight decline, we still have the highest closing value for a weekly chart on record in this calendar year. We are looking at a weekly candlestick chart of gold futures. A much different trading week than last week. When you take a look at the subsequent low that hit last week just below $1,680, and even more importantly, the recovery, because the market actually closed above the open on Monday. And when we compare last week's trading activity, the exaggerated range, to this week's muted range and fractional gains, we have to say two things. First of all, it's a far different market than we witnessed last week with a tremendous range, 1680 on the low, 1780 on the high. This week, we can also say that on a weekly chart, we do have a higher low, we do have a higher high, and we have a higher close when compared to last week's close, as well as a higher close when compared to the open on Monday. That, when you couple it with the gains in dollar strength of almost a full percentage point, tells us that there is buying in gold right now, and that is significant because there is so much underlying pressure because of dollar strength that any kind of small gains that have been eked out have been done so against tremendous cross currents and headwinds. Which brings us to our analysis basis, a daily candlestick chart. And we've been talking throughout this week and last week that although we had a strong rally come into the market after market forces took gold pricing down to just below 1680, 1678 to be exact, and then on Tuesday of this week touched within striking range of $1,800, we have really seen a series of lower closes, lower lows, lower highs, but more than anything else, we can say that it has been trapped in a very narrow and defined trading range, which means that we could in fact see the market consolidating. It could be forming a top, and that's what we have speculated throughout the week, that according to Elliott wave models, we would look for this to be some sort of an A wave, which is either terminated on Tuesday or will terminate somewhere between 1796, the 50-day moving average, and 1814, the 200-day moving average. There is another possibility, and that possibility, of course, is that the fundamentals are strong enough to actually move gold prices higher. Now, to me, that wouldn't be a strong signal unless we broke through at least the 100-day moving average at 1807 on a closing basis. That would tell me that what we have been witnessing is consolidation in the market rather than a simple top, which would be followed by lower pricing. That model, though, is still on the table. There is no doubt. We have not been able to breach 1800. It is likely that the high that we witnessed on Tuesday will remain the high just shy of 1800. If that's the case, we could see market forces take gold pricing to anywhere between $1,700 and $38. That is a 50% retracement of the rally that began on the 9th and then concluded mid-month, and it could go as low as 75%. That's what a basic Elliott wave model looks for on an ABC type correction. Next week, depending on how the market opens, if we see any kind of firming as it opens in Asia and Australia on Sunday, we will look at variations off of that, the potential that we are still in a rally mode, and that would be determined only by a confirmation of a solid close above 1800 or other types of corrections. Because as we talked about a little bit yesterday, the simple A, B, C, which is a bear count correction, is only one type. There's many other types, and one other type that we can typically see is where the market will trade higher, and rather than only having an ABC, it will have an A, a B, a C, a D, and an E, and that will be followed by what's called the thrust line, breaking through the lower level support of this compression triangle. That is another way that a actual correction can unfold and is just as valid as an ABC correction. And typically, another part of Elliott wave theory looks at the fact that you will get out of your two corrective waves, waves 2 and 4, one that is a typical ABC and one that is more like a wedge pattern, a pennant formation, or a compression triangle, however you want to label that. You will typically see both of these occur, one with either the corrective wave 2 or the corrective wave 4. This has been Gary Wagner wishing you, as always, good trading. We'll talk to you on Monday for the next daily update and review. Bye-bye.